Investor attention will now turn to the government's monthly jobs report that is due on Friday. Now, to put some of this into context and to tell you what to expect going forward, I'm joined by Geoffrey, who is independent emerging markets commentator. Geoff, thanks so much for taking the time this morning. Help us understand why we're seeing such a sharp rise in bond yields, and we've seen that over a couple of sessions. We're now at 4%, whereas a week ago we were at 3.8%. Seemingly, the bets of very aggressive rate cuts are being pulled back.
I think that latter point is absolutely one of the keys here. I think there's two things going on here. First of all, we had such a strong fourth quarter, and especially a very, very strong December, that I think there's just some natural profit taking as you go into the new year, investors being a little bit more cautious. But if you want a real factor, I think you put it down to the fact that the FOMC minutes really tried to make the point that the Fed was not particularly thinking about rate cuts at this stage. So the minutes turned out to be much, much more bearish, or somewhat more bearish than Chair Powell was in his press conference following the December meeting. At the same time, one of the regional governors also argued that they may even have to raise rates again. So I think what that's done is push the market's views of rate cuts out to perhaps the second half of the year. I've said the second half of the year for quite some time is more likely. And I think that's contributed to this sort of risk-off situation where bond yields have gone up, albeit they're still way down from where they were just a few weeks ago, and also a sharp move higher in the dollar so far this year. It's all classic sort of risk-off, and I think you put it down to those two factors.
Okay. Now, ordinarily, the jobs data or the information on jobs that we got overnight from the US would have led to a little bit of a bullish sentiment, but that hasn't really played out. I'm just trying to understand, we're looking at a structural move, obviously, over the course of the next year and a half, perhaps, with interest rates expected to come down. So this, would you say, is a classic speed bump in the road? And, you know, structurally, we're going down for bond yields and up for equities over a period of time, assuming, of course, that soft landing does take place.
Yes, you're right. I think it's a speed bump, but I think it's worth pointing out that with the size of the US trade deficit, and in particular the size of the US budget deficit and the level of debt in the US, I think it's wrong to assume that bond yields will go that much lower. I suspect bond yields for 10 years will probably go to 3.5%, maybe by the spring or the early summer. But I don't think they're going to go much lower than that. And therefore, some of this good news is already come through. So I am constructive on equities this year. I'm particularly constructive on emerging markets, but I'm constructive on equities generally. But I don't think we're going to have as good a year as last year, because the drivers here, the macro drivers, will not be as helpful. They will be helpful, but not as helpful as they were in 2023. And of course, we're sitting, certainly in the US anyway, at very, very high valuations. Now, on the jobs numbers, I wouldn't worry too much about I don't think the market should worry too much also about the ADP figures. The payroll numbers today, or today your time, are going to be much, much more important. And I think that's going to give us a better idea on whether the softening of the labor market that we've seen recently is continuing and what the outlook is for wages. So we're in a situation right now where bad news is good news. So if we got a softer labor market report, especially on the wage inflation front, the markets would like that because it would potentially bring earlier Fed rate cuts into play.
Last very quick question. Geoff, when do you expect the rate cuts to actually pan out? What are your own expectations?
I think it's going to be sometime around the middle of the year. Now, we do know that the Fed is talking about 3 rate cuts this year. The market seems to want more, at least it did want more. I think it's a question of interest rates staying higher for longer. And if we do get rate cuts this year, which I think we will, they'll probably all be in the second half. Maybe we get one in June, but it's going to be around mid-year with the first one, and then potentially a couple more later in the year.
Yes, all right. Thank you so much, Geoff, for joining us this morning and giving us that perspective. perspective.